if I told you that the ultimate secret to building just massive tax-free wealth was to buy a life insurance policy, but to, like, mathematically engineer it so it pays out almost nothing when you die?
I mean, honestly, it sounds like a complete paradox
Yeah.
or, just a straight-up scam.
Mm.
But it is actually this highly sophisticated strategy used by the ultra-wealthy.
Yeah.
And we have the internal playbook detailing exactly how it's done.
Right, which is just wild. So, welcome to today's deep dive.
All right.
We are really sneaking behind the curtain of high finance sales today because we've got our hands on a really fascinating piece of internal audio.
Yeah, it's a training seminar for financial agents,
Mm.
specifically those working in an advanced planning division.
Exactly. And we aren't just, giving you a textbook definition of what Indexed Universal Life Insurance, or IUL, is.
Yeah.
We are unpacking the exact psychology, the software hacks, and the sales pitches that elite agents use to structure these massive financial products for high net worth clients. Yeah, and what's fascinating here is that this isn't just some standard corporate memo. We are listening to a literal masterclass in behavioral psychology and software engineering.
Totally.
It reveals how a product that's traditionally associated with death, and mourning, is reverse engineered into this living, breathing, high-yield financial multi-tool.
Okay, let's unpack this. Because before these agents even boot up their computers to, build a financial product, the trainer starts with just pure, unadulterated psychology, like the psychological bait.
Right, the setup.
Yeah. The trainer uses this incredible fishing analogy. He tells this room full of agents, like, if you want to catch a bass, you can just use a regular hook and a worm. But if you want to catch a marlin, you need a massive hook, heavy-duty line, and serious bait.
Because the trainer is establishing that you just cannot use middle-class sales tactics on high-net-worth individuals. I mean, he gives a really specific example of a hypothetical client making $2.5 million a year.
Which is a huge income.
Right. And if an agent sits down and suggests, saving $200 a month, they instantly lose all credibility. To land that marlin, the agent pitched putting $250,000 a year into the policy.
Which, just feels like an absurd amount of money to pitch someone for life insurance.
Mm.
But the trainer is teaching a textbook application of anchoring, isn't he?
He absolutely is, yeah. Anchoring is this cognitive bias where humans rely really heavily on the very first piece of information they're offered.
We don't evaluate numbers in a vacuum.
Exactly. We need a reference point. So if a hypothetical client, let's call her Alma, makes $250,000 a year, the agent is instructed to anchor extremely high, like showing her a premium of $2,000 a month or maybe even $50,000 a year.
That reminds me of walking into a gym. Like if you try to pick up a 100-pound dumbbell, your brain just registers it as impossibly heavy.
Right, you can barely budget.
Yeah. But if you put it down and immediately pick up a 50-pound dumbbell, the 50-pounder suddenly feels incredibly light. Your brain recalibrated based on that first heavier weight.
That's a great way to think about it.
But honestly, as a consumer, if I'm sitting across the desk and an advisor just casually asks me for $24,000 a year, I'm heading for the door. Doesn't starting with such a huge number risk completely terrifying the client and just blowing the sale entirely?
Well, it is a deliberate, calculated risk.
Oh.
But the trainer provides this very specific safety valve in the script.
Oh, really? How does that work?
The agent drops that massive anchor and simply watches the client's reaction. If Alma balks and says, there's no way I can afford 24 grand a year, the agent doesn't argue. They don't justify it or push back.
They just let it go?
They instantly pivot. They just ask, okay, well, what are you comfortable with?
Ah, so they completely flip the dynamic.
Exactly. Creates this illusion of control. Alma suddenly feels like she is in the driver's seat, negotiating the price down.
Right, she's the one setting the terms now.
Yeah. She might look at her budget and say, well, I could probably swing $1,000 a month. And the agent enthusiastically agrees. So Alma feels like she won this massive concession, but the agent just secured a $12,000 a year premium.
Because if the agent had started timidly at $200 a month,
getting her up to $1,000 would have felt like pulling teeth.
Right, because once you anchor at $200, asking for $1,000 feels like robbery. But anchoring at $2,000 makes $1,000 feel like an absolute bargain.
It's pure psychology.
And to normalize this, the trainer even tells the agents that they need to personally invest heavily in their own IUL policies. He talks about how he started at $250 a month, but as he made more money, he bumped his own contributions to $9,000 a month.
Which is a huge commitment.
Yeah. He essentially had to brainwash himself into believing that dropping 10 grand a month on insurance is totally normal, just so he wouldn't flinch when pitching it to a client.
Well, it bridges the gap between theory and conviction. When you are actually putting your own money on the line at that scale, pitching it becomes completely authentic.
Okay, but here's where it gets really interesting. They've anchored this massive price tag, right? They've got the client comfortable with the idea of parting with tens of thousands of dollars a year. But what exactly is the client actually buying?
Right, the actual product.
Because the trainer explicitly warns the agents, and this is just wild to me. He says, never ever sell the IUL as a life insurance policy.
Which, on the surface, is completely absurd. The product is literally called Indexed Universal Life Insurance.
I know, but the trader argues that the moment you frame it as a death benefit, the client's brain just shuts down. They immediately ask, like, what is the absolute minimum I have to pay to get this over with?
Because nobody wants to fund their own demise.
Exactly. I think of it kind of like selling a high-end $1,000 smartphone. If you pitch that device to me purely as a machine to make phone calls, I'm going to laugh you out of the store. I mean, I can make calls on a $20 burner phone.
But if you pitch the 4K video camera, the GPS, the internet browser, the facial recognition...
Suddenly, that $1,000 price tag is a total steal. I'm not buying a phone. I'm buying a supercomputer for my pocket.
Yeah, and if we connect this to the bigger picture, this is really about understanding the core desires of high net worth individuals. Wealthy clients, like our hypothetical Alma, want utility right now.
They don't want to wait until they're dead.
Exactly. They are looking for leverage, tax advantages, and liquidity while they are alive. So the agent is trained to completely ignore the death aspect and focus entirely on these so-called living benefits.
So let's talk about those living benefits, because one phrase just gets thrown around constantly in this audio, and that's infinite banking.
Oh, yeah. Very popular concept.
It sounds like a TikTok buzzword, honestly. The trainer pitches it as the ability to take money out of the policy and pay yourself back while your original money still earns interest.
Right.
That sounds like mathematical magic. How did that actually work for the listener who might be wondering how money can literally be in two places at once?
Well, it's not magic. It's collateral. And this is a really crucial distinction to make. When Alma wants to, say, buy a rental property or fund a new business venture, she doesn't actually withdraw her cash from the policy.
Wait, really?
No. Instead, she takes a loan from the insurance company's general fund, and the insurance company uses Alma's cash value as the collateral to secure that loan.
Oh, I see. So her actual money never leaves her account.
Precisely. Because her money never left, it just continues to compound and earn index interest as if she never even touched it.
That is insane.
She uses the insurance company's money to buy her real estate, and her own money keeps growing tax-free in the background. Yeah. And they also pitch using the policy to generate tax-free retirement income down the line. Plus, they highlight these critical illness riders.
What are those?
Basically, meaning if Alma has a heart attack or gets cancer, she can actually access a huge chunk of the death benefit while she is still breathing to pay for her medical treatments.
Okay, so when you frame it as a tax-free, high-yield vault that also acts as a medical safety net, asking for $50,000 a year stops feeling like a pesky insurance premium.
Right, it starts feeling like an exclusive wealth club.
Exactly.
Yeah.
But here is the friction. You can't just take Alma's 50 grand, dump it into an off-the-shelf life insurance policy, and expect all these magical living benefits to just happen. The policy will implode.
Yes, it will.
The agent actually has to hack the software.
This is where the sales pitch meets hard, cold software engineering. The training seminar goes really deep into the weeds of these platforms like WinFlex and CoreBridge.
Yeah, the technical part of the audio was intense.
It was. And the trainer gives this absolute non-negotiable directive. He says you must build a no-violation, minimum, non-MEC policy.
Okay, I was practically screaming at the transcript when I read this part.
Mm.
Isn't the fundamental point of life insurance to get the biggest possible payout for your family when you die?
Traditionally, yes.
So why is the trainer insisting that agents mathematically shrink the death benefit to the absolute smallest amount possible?
Because the death benefit is the enemy of the cash value. You really have to understand the internal mechanics of universal life here. Every single month, the insurance company deducts what's called the cost of insurance from the money you pay in.
Okay.
And that cost is directly tied to the size of the death benefit. If you have a massive, multi-million-dollar death benefit, the internal cost of insurance is astronomically high. It just eats up all the cash you're putting in.
It's like trying to fill a bucket that has a massive hole drilled in the bottom. Like, no matter how much water you pour in, it just drains out to pay the insurance company.
Exactly. So to plug that hole, the trainer instructs them to shrink the death benefit to the absolute minimum allowed by the IRS.
Wait, pause. Why does the IRS even care how small my life insurance payout is? That seems weird.
Oh, this is a fascinating piece of financial history. So decades ago, extremely wealthy people realized they could just dump millions of dollars into life insurance policies, declare a tiny, meaningless death benefit of maybe a few $1,000s, and essentially use the policy as an unregulated, tax-free offshore bank account right here in the U.S.
Oh, wow. Because the growth inside a life insurance policy isn't taxed.
Right. Congress caught wind of this and realized people were totally exploiting the tax code. So they created the MEC limit. That stands for Modified Endowment Contract.
Okay, MEC.
The IRS drew a line in the sand that basically said, look, if you shrink the death benefit too much compared to the cash you're dumping in, we stop legally recognizing it as life insurance.
It becomes a MEC.
Exactly. It becomes an MEC and you lose all your tax advantages. It just gets taxed like a regular everyday investment.
So this minimum non-MEC rule the trainer is shouting about, the goal is to shrink the death benefit to the precise mathematical razor's edge of that IRS limit, but not a single penny further.
They are tiptoeing right on the absolute legal boundary. By doing so, they reduce the internal cost of insurance to just a tiny fraction.
So almost all of Alma's $50,000 premium completely bypasses the insurance costs.
And drops straight into the cash value, where it catches the market index and grows exponentially. They are intentionally choking off the death benefit to supercharge the living cash value.
I mean, that is brilliant, but it's also incredibly risky if the agent doesn't actually know what they're doing. And the trainer actually stops the whole technical demonstration to issue a pretty stark warning to the room.
Yeah, the tone really shifts there.
He tells the agents they must structure these policies properly, both to protect the client and to protect the company.
He specifically tells them, don't become WFG 2.0. He's referring to the reputational damage that happens when agents get greedy.
What do you mean by greedy in this context?
Well, you see, an agent's commission is often tied to the size of the death benefit. So there is this massive temptation for the agent to bump up the death benefit just to earn a larger upfront paycheck.
Even though it ruins the cash value growth for the client long term.
Exactly. And he warns them that there are watchdogs all over social media right now actively exposing these improperly structured IULs and publicly naming the agents who sold them.
Right. He's making it crystal clear. Like, if you build bad policies just to line your own pockets, it will inevitably blow up on TikTok, and it will drag the whole agency down.
It is a sobering reminder that this kind of financial engineering has real-world consequences for the consumer.
Okay, so let's assume the agent follows the rules. They've successfully shrunk the death benefit to that MEC limit. Alma's cash value is growing like crazy. But how does the agent engineer the policy to actually spit out that maximum retirement income?
Because eventually she wants to use the money.
Right. If Alma wants to retire early and live off this thing, how does she get the money out most efficiently?
The trainer reveals a highly specific software toggle to make this happen. It is all about changing one setting, the exact year the client decides to stop funding the policy and retire.
Okay, walk me through that.
Say Alma puts in $50,000 a year until she is 56, and then she stops. At age 56, the agent programs the software to switch the death benefit option from increasing to level.
Increasing to level. Let's really break that down for you listening. What does flipping that switch actually do to the money inside the policy?
This raises an important question. When the cash value inside the policy earns compounded interest, where does that money actually go?
Good question.
Let's use real dollars to make this clear. Imagine your cash value earns $5,000 in interest this year. If the policy is set to increasing, the software automatically takes a chunk of that $5,000 and uses it to buy you more death benefit.
So the payout when you die goes up.
Yes.
But wait, we established earlier that a bigger death benefit means higher internal costs.
Exactly. So right when Alma retires at 56 and stops paying premiums, the agent flips the switch to level. This freezes the death benefit permanently.
Oh, I see.
Now, when the policy earns that $5,000 in interest, none of it goes toward buying more insurance. The entire $5,000 drops straight into Alma's usable cash pocket.
Because by freezing the death benefit, you eliminate those rising costs right at the exact moment she needs to start drinking from the bucket.
You got it.
That drastically increases the amount of tax-free income she can pull out every single year. It is just wild to me that someone's entire financial destiny can come down to a single drop-down menu in a software program called WinFlex.
And the trainer really prides himself on mastering these obscure software menus. I mean, he tells this incredible anecdote about the COVID lockdowns.
Oh yeah, the Mario story.
Right. He claims to be the first person to figure out how to illustrate these infinite banking loans natively inside the software itself, so the client could actually see the exact math right on the paper.
He talks about getting his colleague, Mario, onto a Zoom call to show off this breakthrough. He shows Mario a policy structured for $30,000 a year.
And Mario is initially pretty skeptical. The audio mentions that the target premium, which is the metric or kind of the points that agents use to calculate their commission, was only around 11,000 points.
And Mario argued it should have been structured to yield 18,000 or 19,000 points for the agent.
Meaning Mario wanted to alter the structure to maximize their own paycheck at the expense of the client.
Right. But the trainer insisted that this new structure was so incredibly favorable for the client that it would practically sell itself.
And he was right. He closed the deal, and the client was so blown away by seeing the infinite banking math play out in the software that they instantly generated 5 new referrals who wanted the exact same setup.
Which just proves a fundamental law of high-end sales. Like, when the underlying math undeniably favors the client, you don't even need pressure tactics. The sheer utility of the product just pulls the client in. Which brings us to the ultimate close. We've seen the anchoring psychology, we've seen the reframing of living benefits, we've seen the software mechanics of minimizing the MEC limit and toggling the level option.
All the pieces are on the board.
Exactly. So how does the agent ultimately bring this all together to get a client like Alma to actually sign on the dotted line?
It really comes down to creating an immediate jaw-dropping contrast in value. The agent walks Alma through the very first line item on the software illustration, just the year 1 numbers.
The agent says, Alma, in year 1, you put in $50,000. Immediately, you have a liquid cash value of about $43,000.
Which is pretty reassuring. It shows her money isn't just locked away in some black box.
It is reassuring. But then comes the absolute hammer. The agent points out that immediately, upon making that first deposit, her death benefit jumps to over $1 million.
And to make the client truly feel the weight of that, the agent contrasts the IUL with a traditional retirement tool, like a SEP IRA.
All right. For you listening, a SEP IRA is a standard tax-deferred retirement vehicle that's heavily used by self-employed business owners like Alma. You put money in, it grows, and you pay taxes when you take it out.
So the agent sets the scene. They say, Alma, if you take that same $50,000 and put it into your SEP IRA, and then you tragically walk outside and get hit by a bus in year 1.
A bit morbid, but okay.
Your family inherits your $50,000, but they owe the government income taxes on it.
That is a harsh reality.
But then the agent pivots. They say, however, if you put that same $50,000 into this IUL, and the worst happens, your family instantly receives over $1 million completely tax-free.
That contrast is unbelievable. I mean, $50,000 taxable versus $1 million tax-free for the exact same initial cash outlay.
It is the ultimate emotional hook. It seamlessly bridges the logical, mathematical, wealth-building aspects, the cash value, the infinite banking, with the primal emotional desire to build a fortress around one's family.
Now, the trainer does throw in a technical caveat for the agents here. He notes that with the specific Corebridge software they are looking at, Alma couldn't actually access that $43,000 in year 1 if she wanted to.
Right. There are limitations depending on the carrier.
Yeah, for immediate year 1 liquidity, they would have to build the policy using a different carrier entirely, like North American or Anaco.
Different tools for different jobs.
Yeah.
But the core argument remains identical. The immediate leverage of transforming a $50,000 deposit into a $1 million tax-free shield is a phenomenally powerful way to close a high-net-worth sale.
So what does this all mean? We've spent this time really digging through an internal corporate training seminar, translating software acronyms and tax code limits. But this deep dive wasn't really just about financial jargon.
No, not at all.
It was a fascinating case study in how value is framed. It shows how elite agents can take a product that average consumers naturally resist, and by combining behavioral psychology with a mastery of IRS loopholes, transform it into an irresistible financial fortress.
And for you listening, whether you are currently shopping for financial products, whether you sell a service yourself, or whether you just want to understand how money truly moves in our economy, This is vital context.
Absolutely.
Knowing how these deals are constructed behind the software screens, understanding why an advisor anchors a massive number, or how the internal cost of insurance dictates your returns, it fundamentally changes how you evaluate the financial advice you receive.
You are no longer just nodding along to a glossy brochure. You actually understand the hidden math making the gears turn.
It changes your entire perspective. It makes you realize that the most powerful financial vehicles aren't just sitting on a shelf waiting to be bought. They are custom engineered by people who know exactly which levers to pull.
They really are.
But exploring the absolute limits of this engineering leaves us with a provocative question to consider.
Okay, what's that?
We just learned that the entire mechanism of this wealth-building strategy relies on mathematically choking the death benefit to the absolute very edge of the IRS MEC limit.
Right.
They are exploiting a gray area in the tax code to create a tax-free, high-yield banking alternative for the wealthy.
Tiptoeing right on the legal line.
Exactly. So the question is, what happens if these strategies become too popular?
Oh, wow.
If thousands of high-net-worth individuals start funneling billions of dollars through these custom-built life insurance policies to legally avoid taxes, will the government eventually step in and close the MEC loophole entirely?
That is a terrifying thought for anyone holding one of these.
And if the IRS rewrites the rules to shut this down, what happens to the billions of dollars already locked inside these